Look, I need you to picture something for me. You've been working your job for 5 years, maybe 10. You're making decent money, let's say $100,000 a year. Sounds good, right? Except every single year you watch $18,000 to $22,000 disappear from your paycheck before you even see it. Gone. And then you look at your coworker, same job, same salary, and somehow they're driving a nicer car, taking better vacations, and they just bought their third rental property. And you're sitting there thinking, what am I missing? That was me 4 years ago. Completely confused. Making good money, paying massive taxes, and getting nowhere. My name's Alex, and I spend way too much time thinking about why some people build wealth effortlessly, while others work just as hard and stay broke. If you're someone who feels like you're doing everything right financially, but still can't seem to get ahead, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because here's the thing, and I'm just going to say it. You're not failing at money. You're just playing a completely different game than wealthy people. And nobody ever told you the rules changed. So let me ask you something. When you think about getting wealthy, what's the first thing that comes to mind? Work harder, get a raise, maybe start a side hustle, sell something for profit, right? That's what we're taught. Earn money, sell things, make profit, pay taxes, repeat. And look, I'm not here to tell you that's wrong. But here's what most people don't realize. That's the worker's playbook. And there's a completely different playbook that wealthy families have been using for generations. And the gap between these two playbooks? It's not about intelligence, it's not about working harder, it's about information that you were simply never given access to. According to a 2023 analysis by the Tax Foundation, the top 1% of earners pay an effective federal income tax rate of around 26%. Meanwhile, someone making $100,000, solidly middle class, pays an effective rate of about 18 to 22% when you factor in federal, state, and payroll taxes. Now you might be thinking, wait, the rich pay more. But here's where it gets really interesting. That 26% is only on their reported income. And wealthy people structure their lives to have as little reported income as possible. Let me show you what I mean. Here's the core difference between how workers and owners think about money. Workers think in terms of income and expenses. Owners think in terms of assets and leverage. When a worker gets a $100,000 raise, they think, great, now I can afford a bigger house. When an owner gets a $100,000 increase in equity, they think, great, now I can borrow against this to buy another asset. See the difference? One is thinking about what they can buy, the other is thinking about what they can acquire that makes them more money. And here's the psychological trap that keeps most people stuck. We've been conditioned to fear debt. Your parents probably told you, pay off your house as fast as possible, don't carry debt. And for consumer debt, credit cards, car loans, lifestyle debt, that's absolutely true. But wealthy people understand there's a completely different type of debt. Productive debt. Debt that pays for itself and creates cash flow. Let me give you a real example, because this is where the math gets wild. Let's say you save up and buy a $400,000 rental property. You put down $80,000, that's 20%. You get a mortgage for $320,000. Over the next few years, 3 things happen. 1, your tenants pay down your mortgage. Maybe it drops to $280,000. 2, the property appreciates. Now it's worth $500,000. And 3, you're collecting a few $100 a month in cash flow after expenses. So now you're sitting on $100,000 in paper profit. The property you bought for $400,000 is now worth $500,000. And this is where most people make the biggest financial mistake of their lives. They sell. They think, wow, I made $100,000. Time to cash out and celebrate. And look, I get it. $100,000 feels like a win. But here's what actually happens. That $100,000 profit, that's a capital gain. And depending on your income bracket, the federal government takes 15 to 20% immediately. Some states add another 5 to 10%. So your $100,000 profit becomes $80,000, maybe $75,000. But it's worse than that, because now you've lost your asset. The thing that was producing monthly cash flow, gone. The thing that was appreciating, gone. The tax deductions from depreciation? Gone. You basically just hit the reset button on your wealth-building journey. You scored a touchdown, the referee took 20% of your points, and then sent you back to your own goal line to start over. And here's the really frustrating part. You just triggered a taxable event voluntarily. You chose to give the government that money. And most people do this over and over throughout their lives, wondering why they can never get ahead. Now let me show you how someone who actually understands the game approaches that exact same scenario. Same $400,000 property, same appreciation to $500,000, same mortgage paid down to $280,000. But they don't sell. Instead, they do something called a cash-out refinance. Here's how this works. Most banks will lend you up to 75% of your property's current value. So 75% of $500,000 is $375,000. You currently owe $280,000. That means you can pull out $95,000 in cash. And here's the beautiful part, the part that changes everything. Borrowed money is not income. Read that again. Borrowed money is not income. And because it's not income, the IRS doesn't tax it. So you just put $95,000 in your bank account and you don't owe a single dollar in taxes on it. Not 15%, not 20%, zero. Now you might be thinking, but wait, now you have more debt. That's bad, right? And this is the mental shift that separates workers from owners. Wealthy people don't fear debt. They fear taxable events. As long as the asset produces enough cash flow to cover the debt service, which it should if you bought correctly, the debt is just a tool. It's a bridge that lets your asset keep working while your taxes stay at zero. So what do they do with that $95,000? They use it as a down payment on another property. That second property also produces cash flow. It also appreciates. It also provides tax deductions through depreciation. Then in a few years, they borrow against that second property, and they buy a third. This is what's called the borrow until you die strategy. And yes, that's the actual term wealthy families use. Buy assets, let them appreciate, borrow against the equity, use that borrowed money to buy more assets, never sell, never trigger capital gains taxes, just keep compounding. You know why Mark Zuckerberg and Elon Musk take a $1 salary? It's not because they're humble. It's because they understand this game better than anyone. They own billions of dollars in company stock. If they sold that stock to fund their lives, they'd pay capital gains taxes on hundreds of millions of dollars. Instead, they borrow against it. Banks line up to give them loans at 2 to 3% interest rates because their stock is incredible collateral. So they live on borrowed money, tax-free, and their stock keeps growing, compounding year after year, completely untouched by the IRS.
And here's the part that sounds almost illegal, but isn't. When they die, their heirs inherit those assets with what's called a step-up in basis. That means if their kids decide to sell, they owe zero taxes on decades of appreciation. The whole tax bill just vanishes. This is generational wealth. And it's not a loophole. It's the system working exactly as designed. Now, for a long time, this strategy felt completely out of reach for normal people. You needed millions in stock options or massive amounts of capital to even play this game. But here's what changed, and this is where everyday W-2 workers can actually enter this world. The vehicle is real estate, specifically short-term rentals. Here's what most people don't realize about the tax code. The IRS treats long-term rentals and short-term rentals completely differently, and that difference is massive. With a long-term rental, the losses you generate, paper losses from depreciation, can only offset other passive income. So if you don't have other rental income, those losses just sit there, doing nothing for your W-2 taxes. But with a short-term rental, defined as an average guest stay of 7 days or less, if you materially participate in managing it, the IRS treats it like an active business. And losses from an active business can offset your W-2 income. Let me say that again because it's critical. If you own and actively manage a short-term rental, you can use the paper losses to reduce your day job taxes. And when you combine this with something called bonus depreciation, that's when things get absolutely wild. Normally, when you buy a rental property, you depreciate it slowly over 27.5 or 39 years. So if you buy a $400,000 property, you might deduct around $10,000 to $15,000 per year. Bonus depreciation says, forget that. Take a massive chunk of that depreciation in year one. Through a cost segregation study, which is basically an engineering analysis that breaks down your property into components, you can typically accelerate about 25 to 40% of your property's value into year one depreciation. So on a $500,000 short-term rental, you might generate $125,000 to $200,000 in paper losses in year one. And remember, because you're materially participating, those losses can offset your W-2 income. Let me walk you through a real scenario. You're making $100,000 at your W-2 job. Your typical federal and state tax bill is around $20,000 annually, money you'll never see again. You buy a $500,000 short-term rental property. You get a cost segregation study done. It identifies $125,000 in accelerated depreciation for year one. That $125,000 paper loss now offsets your W-2 income. Your taxable income drops from $100,000 to zero. Your $20,000 tax bill? Eliminated. Gone. You just gave yourself a $20,000 raise without working a single extra hour. And you still have $25,000 in losses left over to carry forward into next year. So now, instead of sending $20,000 to the IRS, you keep it. And here's where the snowball starts. You take that $20,000, combine it with the cash flow from your first property, and you use it as a down payment on a second short-term rental. That second property also qualifies for bonus depreciation. More paper losses, more tax elimination. Meanwhile, both properties are appreciating, both are being paid down by your guests. And in a few years, you can refinance both, pull out tax-free cash from the equity, and buy a third and fourth property. This is the zero tax snowball. And this is how you enter the game that wealthy families have been playing for generations. Let me break down the cycle one more time because this is the framework. Cash flow from your properties grows your equity. That equity unlocks tax-free borrowing through refinancing. That borrowed capital buys more income-producing assets. Those assets generate more depreciation, which eliminates taxes. Eliminated taxes mean you keep more of your W-2 income. More kept income means more capital to acquire even more assets. It feeds itself, and every year you're paying less in taxes while accumulating more assets that produce cash flow and appreciate. You're no longer working just to pay the IRS. You're building a machine that compounds wealth while legally minimizing your tax burden. Look, I know this sounds almost too good to be true. I thought the same thing when I first learned about it. But this isn't a loophole. This isn't some sketchy scheme. This is literally how the tax code was designed to work. The government wants people to provide housing. They want people to invest in real estate and create jobs and stimulate the economy. So they built these incentives into the tax code. The problem is, nobody teaches you this. You're not going to learn it in school. Your CPA might not even know about it if they only work with W-2 employees. This is information that gets passed down in wealthy families or discovered by people who refuse to accept that working hard and paying taxes is the only path. So here's what I want you to do. If this video opened your eyes to a completely different way of thinking about money, hit that like button. Subscribe if you want to see more content that actually explains how money really works. And drop a comment telling me where you are in your journey. Are you already investing in real estate, or is this completely new to you? Because here's the thing. The gap between where you are now and where you want to be isn't as big as you think. It's just information. And you just got it. Now go use it.